our next speaker is George Diab. He, after seeing the need for financial services tailored to fit the individual needs of SMMEs, they founded Gas Accounting to support entities by providing quality accounting and financial management services to them. Being a co-founder and director for various businesses has taught him how crucial research, in-depth client knowledge, perseverance, and being financially savvy are in order to build a viable business. He had the great honor of being one of SAICA's top 35 under 35. He's an entrepreneur, business and tax specialist, leadership advisor, and a tech enthusiast with a desire to help other entrepreneurs build successful businesses. And he's going to be talking to us about a very important topic, which is around VAT and tax and medical professionals. So thank you, Diab. Please come and join us.
Good morning. Thank you for joining. Thanks, Taz. It's great to be here. My name's George. I'm from a company called Gas Accounting, and I'm here to talk to you about the doctor's guide for paying less tax. Just by show of hands, can I just get an idea of who's in the audience? How many doctors in private practice are here? Okay, and how many are still doing their internship? Yeah. And the balance, who's the balance of the attendees? Yeah. Business? The business side of things. Okay, fantastic. Okay, let's hope this ticker works. Great. So I'm going to tell you a little bit about me first, and then we're going to get into the talk. And really, this talk is just a practical talk. It's me just trying to impart as much knowledge as I can with the many years experience that I've got in the industry, and trying to just help guide and inform everyone who's here listening to the talk. My name is George. I'm a loving husband and a proud father of 2 kids. I'm also a chartered accountant by profession, and I spent a lot of time doing business tax structuring. And that was at one of the big 4 audit practices where we specialized in that for a number of years. And I found it quite an interesting space because as much as accounting is a science, it's also a bit of an art. There is an element of creativity to how you plan and structure taxes, and it requires a lot of thinking. There's not just one way to get to the answer. There's multiple ways to tackle it and find solutions to get to the right result. As Taz mentioned, in 2016, I was nominated by SAICA, which is the South African Institute of Chartered Accountants, as one of the top 35 CAs in the country. And that was really for the work that I've done in the thank you. And that was really for the work that I've done in the entrepreneurial space. So while I was still doing taxes, I went on to study my master's in tax at Wits University, and completed all the coursework. And just before I wrote my dissertation to complete my master's, I decided that tax wasn't for me, and went into entrepreneurship. Started a couple of businesses, and ended up exiting them for quite a successful sum of money at the end of the day. And I found that business is a science, but there's a creative art. But lo and behold, not finishing my master's was one of my bigger life regrets. But here I am 12 years later speaking to you about it, thinking that I'll never come back to this industry. I'm the founder of Gas Accounting, and at Gas Accounting, our main focus is really working with business owners and entrepreneurs to help them build more sustainable businesses, to help them get the most out of their business. And as much as doctors don't think they are entrepreneurs or business owners, that's exactly what you are. And many of the things they don't teach you in med school. There's so much information that is imparted on you that is learned. But when it comes to the financial side, when it comes to running your business, there's fundamental gaps. And we really try to fill those gaps up with the information that we share with our clients and, in talks like these. I found doctors are some of the cleverest people, that we actually work with. But some of our best clients are the ones that understand finances, better, that have a better financial understanding of what's happening in their business. I gave an example earlier. Like, if you want to run a good business, you need data. you need information. And that information helps you make better financial decisions in order to grow. Do I hire another person? Do I stay at this premises? Are the services I'm rendering, proving to be effective? It's the same as if I go see you as a patient. Before you can, provide me with the solution or tell me what's wrong, you first send me for blood work. You try to collect all the data that you can about me so that you can give me a recommendation of the right treatment and course of action. And accounting and tax is exactly the same thing. Without data, like accurate, relevant, reliable accounting records in your business, you're unable to provide or make stronger and more decisive management decisions for the growth of your practice. So that's incredibly important. So today we're really going to talk about the business structures to help you, firstly, run a better and sustainable practice. And secondly, a big problem in the medical industry is tax. And what does this keep going on and off? I don't know. Is there another? Can I swap with you?
I think as you.
Oh, is it? Check. Okay, let's try this one. So tax is a really big part of the accounting side on the medical practices. Why? Because doctors generally earn higher levels of income. So your earnings are quite good, and deservedly so. You save lives, you've studied your entire life to get to the position that you are, you're providing a valued service, you've got the right to charge your fees, and you've got the right to earn a good income. But because you earn a good income and because you run a service-based business, typically you don't have a lot of tax-deductible expenditure to reduce your tax liability. So come the end of the tax year, what ends up happening is you've got this massive tax liability that you need to pay. And, what we try to do is structure your taxes in such a way that you pay the optimal amount. So it's not about tax evasion, it's about tax avoidance. How do you pay legitimately the lowest possible amount of tax? That's another problem. And if we've got some time, I'll touch on a couple of the VAT things. But how did I get into medical accounting? So when we started GAS, it was really around, we were a business for entrepreneurs. And then in about 2020, my cousin came to me and he said, George, he's a specialist, said, George, can you help me with my tax and accounting? I said, of course. I mean, how difficult can it be? You're a specialist, you earn a lot of money, you get paid well, you buy nice cars, and you live in cool houses. This is going to be really easy. So as I started unpacking his accounting and his tax requirements, the more I started learning that this is a very niched and specialized industry. It's not just simply sitting down and calculating what the numbers are. It's really about understanding what are all the pain points that medical doctors, specialists, people in the healthcare industry face on a day-to-day basis. And using those pain points, how do we provide solutions that address each of those needs? Tax being one of them, and we're gonna dive into a couple more in a sec. So there's a bit of a journey that you go on. As soon as you qualified and you go into private, you start on a journey, and it's not a one-size-fits-all journey. Some people stay at one point in the journey, and other people progress throughout the journey. But there is a journey nonetheless. So when you start out, the best way to start out your medical practice is as a sole proprietor, right? And the reason for that is it's the fastest way to do it. It's the cheapest way to do it. You don't have to register anything. There's less administrative costs and burdens. And believe it or not, in the beginning, being a sole proprietor actually means you are the most tax effective structure. So individuals pay tax from 18% all the way to 45%, right? But when you're starting your medical practice and your earnings are still quite low, your marginal tax rate, the tax percentage that you're paying, is low. You might be paying 18% or 20%. So starting off as a sole proprietor is hands down the best way to do it. Some people stay there, and other people then grow to a incorporated. Now, the HPCSA requires healthcare practitioners to trade as an incorporated. Do you guys know why? No. Yes. It's exactly that. The HPCSA says that you are, as a registered legal practitioner, you cannot hide behind a corporate structure to avoid your accountability for the medical services that you render. And that's exactly what an incorporated is. An incorporated is what they call a personal liability company. So it doesn't matter that you've got this corporate structure that you're trading through, you are still personally and severally liable for all the debts that happen within an incorporated. So whether it's a medical liability claim, or whether it's a business-related debt, you are still liable for that debt because of the structure you're trading through. Whereas in a PTY, which is a limited liability company, if you trade through a PTY, if things go really bad in that PTY, I liquidate it, I close it down, I move on, and I open up the next one. But you can't really do that as an incorporated. You have to carry personal liability, and that in itself is a risk, right? But, and we're going to get, I'll talk about it more in a sec. But the reason why after you're sole prop and your earnings go up and then your tax payments start going up, the reason you incorporate, register an Inc. is purely a tax decision. There's no other reason why you do it other than it being a tax decision, right? Once we start trading nicely and then the practice starts growing and we start employing other doctors and we've got multiple practices around the country, there comes a need to form what we call a trust structure. And this is again to start optimizing on your tax, but more importantly, to start protecting the wealth that you start creating and to plan for estate duty. And I mean, as doctors, we know that at some point in life, we're going to die. Like, that's a fact. And if we're going to die, why don't we plan for that today? Why don't we start putting the measures in place today to make sure that when our time on this, beautiful earth is done and we're going on to the next life, that whatever we leave behind is A, tax efficient, and B, it goes to our loved ones, our children, our beneficiaries in a way that doesn't cost them. And that's exactly why we go into the tax structure. So we start off as a sole proprietor. As soon as our earnings start going up, we then decide, okay, cool, we're going to register an incorporated. Again, purely a tax decision. And then when our net asset value, and I'm going to touch on all of these in a lot more detail now, but as soon as our net asset value starts going up, then it's time to consider the trust structure. Are you still with me? Yes. Any questions so far? What is the net asset value have to be before forming the trust? We like to think of it as about 5 million. So as soon as your net asset value, and net asset value is basically saying your total assets less your total liabilities. So how much property, value, investments, all that stuff you own, less whatever you owe people. When that hits about 5 million, then it's time to start forming the trust. So the question was, why not open an Inc. from the start? Why start with a sole prop? Okay, so as soon as we open an incorporated, there's costs involved, right? We've got to register a company. We then have to register that company for PAYE. We have to potentially register that company for VAT. Sorry, I might need to see a doctor after this. There's annual financial statements that need to be filed. There's a whole bunch of compliance needs that need to be filed. But incorporateds are taxed at a rate of 27%. That's a flat tax rate, right? Individuals are taxed at a rate of 18% to 45%. So when you're starting out, you might actually find that you're paying less tax. You're in a lower tax bracket as an individual than what you are as an incorporated. I got you. So to move from a sole proprietor to an incorporated, what's that benchmark? It's generally about 850,000 Rand per annum of taxable income of net profit. Above that, then it starts making sense to move to an Inc. Another consideration is to think about when you have to go to the BHF, right? And you have to, when you're trading as a sole proprietor, you go to the BHF and you get a practice number so that you can trade. As soon as you register as an incorporated, you have to go to the BHF and get another practice number so that you can trade as an incorporated. And then often once you get that practice number, you have to go and get contracted into all the medical aids. So sometimes if you know you're going to get to the 850, like some specialists, like I've got some cardiologists and orthopedic surgeons, I know straight away they already gone into like a really good hospital. They're going to go way above the 850,000 in year one. We go straight to an incorporated because there's a lot of administration to go from a sole proprietor to an incorporated, right? But if we're unsure about the growth and the pace of the growth of our practice, then we start as the sole proprietor and then gradually move into the incorporated.
Like a PTY. So what's stopping doctors from moving from an incorporate to being a PTY? Or is there a rule against that? And what does it look like? Thanks.
So what's stopping a doctor from going from an Inc to a PTY?
So let's say you're opening my branch.
Yeah.
Having like more than 5. Are you able to then move from being an incorporated to being a PTY, or would you need to register a group practice in that perspective?
So from a legal perspective, you can transform from an Inc to a PTY, from a PTY to an Inc. You keep almost your same registration number. Everything basically stays the same. But the HPCSA specifically precludes healthcare practitioners from providing healthcare services through a PTY. It has to be through an incorporated.
Can I just come? So just to clarify, so exactly as George said, if you go to the HPCSA website, there's you can find the business practices book, and it clearly states in there that you can only practice as an Inc. But you can open a PTY as a utility company. So what that means is for any non-medical services, so you wouldn't code your practice number wouldn't belong to the PTY. Essentially what you become is like an estate agent sort of, because you are housing multiple practices in your business. But of course, that is not a tax question because there's a whole lot of tax implications to that as well. So any decision like that, you have to actually sit down with somebody who's going to go through the data, as George says, and actually advise you what is the best way to kind of manage that. And then also with the tax number, that's a good question. I mean, the practice number, you can retain as a sole prop your own practice number and actually open up a group practice number under your Inc. Or you can open a practice number, a group practice number, and you still keep your individual practice number, because if you have multiple practitioners working for you, when you're on your invoice, you have to have your ICD-10 code and your procedure code. You can have another column in your invoice that states the practitioner practice number. So if I work for you and I'm seeing your patient, seeing a patient in your practice, the invoice will show the group practice number on the letterhead, but in the actual invoice line items, it will show my practice number, indicating that I'm the practitioner doing the treatment, but the practice is billing for the service. Does that make sense? Yeah.
So then, can you, as a doctor, either sole prop or incorporated, to a PTY?
Can you be a consultant to a PTY? But consultant is not necessarily clinical services, or is it? Okay, yeah, so that's, sorry, George, we're hijacking you. So that's a different question, because that is not, so you cannot be employed as a medical professional by somebody who's not in the same registration category, right? But you talking about as an independent practitioner, you are providing consulting services. That is fine because you are not owning that PTY. So the PTY basically becomes the person you're providing the service for. The same as an occupational therapist. If I provide services to the children, but the school says they will pay for that out of the fees, even though the child is the patient, the school is the payer. They're the account holder. So it doesn't matter if the school is a PTY limited, because I'm still practicing as a sole prop or an Inc. and I'm invoicing them on my legitimate structure. Does that make sense? Okay. Thank you, George.
Thanks. Yeah, those were great questions, and the one question that was asked is really around a practice management company, which you can see in the structure of here. Under the trust structure, we have a management company or practice management company, and it's a technique that we use in order to get funds from an unprotected position into a protected position, which I'm going to touch on in a sec. But yeah, you're preempting. So let's quickly just look at a sole proprietor. So it's when you start your practice. Again, like we said, there's very low administrative and setup costs. So the barriers to entry of starting as a sole prop is really simple. There's no formal registration. It's not like you're going to SARS or the CIPC or any regulatory body to say, yeah, look at me, I want to be a sole prop. You just start your business. You go to the BHF, you get your practice number, you sign up to a good medical billing bureau so that you can start collecting collecting fees. And then you need a set of accounting records so that at the end of the tax season, you can obviously file your taxes. You're not VAT registered typically when you start. And VAT is one of those areas where I always encourage medical professionals to avoid it as long as humanly possible. What happens with VAT? And it's not like many other businesses, right? So we start gas accounting and I charge 1,000 Rand for service. And then I cross the VAT registration threshold, which is 1 million Rand a year. And it's too low. I mean, that number hasn't changed since 2012. What's that like? No, it's 2009. It's 16 years. They haven't adjusted the VAT registration threshold. But nonetheless, now I sell my services for 1,000 Rand and then I have to register for VAT. What do? I just charge you 1,150 Rand. So I'm still getting my 1,000 Rand. The 150 that you pay, I keep, and then I pay that over to SARS because remember, as VAT, we act as agents, intermediaries. We're a conduit. We collect money on SARS's behalf. We pay it over to SARS. That's our job. But in the healthcare profession, when you're contracted to medical aids, the medical aids pay you one all-inclusive price. So if the scheme rate is 1,000 Rand for specific treatment, before you VAT registered, you get to keep that full 1,000 Rand. That's yours. But as soon as you register for VAT, 15% of that 1,000 Rand, which is roughly 130 Rand, you have to put aside and that goes to SARS. So in theory, as soon as you register for VAT, you become 15% less profitable in your business. And I don't know if you guys saw, but SARS is considering, or not SARS, Treasury is considering increasing the VAT rate from 15 to 17%. So there goes another 2% of your hard-earned money. So delay or avoid that VAT registration as far as humanly possible when you're all prop. But when you hit 1 million Rand turnover, you have to register for VAT. And this is something that SARS is monitoring a lot more diligently. ₦1 million turnover, not net profit, turnover.
George, could you maybe just clarify for people who don't know what the difference is?
Net?
Can you clarify what is the difference between turnover, for people who don't know what
turnover and profit? It's like when I'm sitting in a doctor's office and they're breaking down my diagnosis and I'm still like, I don't understand. Just tell me what I must take. Turnover is your billings. It's your fees. It's the amount that you're charging your clients. Profit is the amount that's left over at the end of the day after you've paid all of your expenses. So that's a very simplified example.
Yeah, the reason why I wanted you to clarify that because it's so important. Because the thing is, every time you send out an invoice, even if the patient hasn't paid you yet, that's turnover. So VAT has implications on your cash flow because you have to pay that VAT whether the patient paid you or not. So it's just important to remember that as well.
Yeah. So where VAT is really bad is you have to pay VAT on amounts that you possibly haven't even received yet. But it's the same with tax. And in your medical practice, I always say, actually in any business, if you're running a business, the two most important things in your business is A, you send out your invoices as fast as possible. B, you collect your money as fast as possible. Everything else will fall into place. Money makes most of your problems go away. So invoicing, number one, collection number 2. And if you don't get those fundamental principles right in business, then you're not actually running a business. Then you might be providing pro bono services, which, is also nice, but it doesn't pay for private schooling. So it's a tax efficient structure like we discussed, and how sole proprietor or individual tax works, it works on a sliding scale. The more you earn, the more you pay. Whereas VAT, it's a flat 15% across the board. And what we try to say is when your effective tax rate hits about 35%, at that point, and it's about 850,000 Rand per annum in earnings, at that point it's time to consider registering as an incorporated. So registering the Inc. is purely a tax decision. An Inc. carries personal liability. The personal liability part is the part that really scares me, right? And you're already providing medical services. Medical services are quite high risk. Something goes wrong and your PI doesn't cover because of whatever reason, you in your personal capacity are liable. And what that liability actually means is anything you own can become part of a legal dispute or a claim. So whether it's your investment funds, your retirement annuity, whether it's your house, your holiday house, your car, whatever it is, anything that sits under your name can become part of a civil claim, whether it's through the rendering of medical services or whether it's through just a bad business decision. And the reality is we all make mistakes in business. Sometimes we enter into a bad transaction. We go into a terrible loan. We get into a bad investment. Even with those things, because of the incorporated and because it's a personal liability company, your entire estate, it's seen as one. You and your company are seen as one, can become part of a claim or a legal dispute. Now, I want to tell you a story around the next point, the optimal split between individual and company. And this is how we work. And this is where a little bit of the art part of accounting comes in. I've actually got a lot of clients, but I've got 2 clients that I want to mention. The one is a specialist, does extremely well. He earns about, let's call it roughly 1.3 million a month. And you can't believe he doesn't have any money. He's got no money, nothing. He's got 0 money in his bank account. And he came to me and we sat in his office now at tax season because he owed a very big tax bill that he couldn't pay. And we sat together and we had a conversation around where his money's at. And what his accountant was doing was he trades as an incorporated. And once they determined what the profitability for the incorporated was, they paid all that profit to him as a salary. And he was paying 300,000 Rand PAYE every month. And I was like, it's mental. And then on the other side, I've got a client who says, where his previous accountant said, no, because the incorporated's tax rate is lower, let's leave everything in the Inc., and then we'll just build up a loan account. So spend out of the Inc., and then we rack up this loan account, and eventually, we'll settle it when there's cash. And what then happens is, we miss out on a valuable tax planning opportunity because we want the money to go into your name. The business is its own entity. At some point, the money has to go to you in your personal capacity. It has to. And when that money goes to you, it can go to you in 2 ways. It can go to you in terms of remuneration, salary, drawings, all the same thing. Or it can go to you in lieu of a dividend. So we can declare a dividend. But as soon as you declare a dividend, guess what? There's a 20% dividend tax. SAICA's got us covered. Like whatever we think, every time we think we're cleverer than them, they come back with something better than what we had. But you have to find the optimal blend in every tax season. So this is every March to February. You have to do a tax calculation to find the blend of what salary should the doctor be taking on a monthly basis or a drawing. It doesn't have to be a salary. It can be a drawing. What drawing could the doctor take on a monthly basis in order to make sure that our effective tax rate is below 27%? That's 850,000 Rand like to get you to 27%. You can even push that a little bit more if there's more deductions that you've got, like retirement annuity fund contributions, work from home allowances. There's a whole bunch of other stuff we can bring in. But if you don't do it in every tax year, you can't go back and redo it. So finding the optimal blend between what you should take as a salary every month versus what you should leave in the business is incredibly important as a tax planning opportunity. And I mean, with respect, you need to work with the tax advisor to advise you on that. Because accountants are really good at what they do, but sometimes they just don't get that tax element 100% right, and it ends up costing you a lot of money. Now, I think this is really important. So whether we leave the tax in the incorporated or whether we pay it out to you, you still pay tax, right? This is not a tax evasion scheme. This is not a get-rich-quick scheme. I promise you now, we're not cheating the system and beating SARS. They're always going to win at the end of the day. But what we're trying to do is we're trying to defer the tax that you pay so that we can rather keep money into your bank account rather than pay it into SARS's bank account. And if money is kept in your bank account, guess what you can do with it? You can go and build your practice better. You can go buy another practice. You can go hire people to work within your practice to grow your practice. You can grow the value of your estate. You can take that money, you can invest it, and hopefully get a really good return on investment. Because at the end of the day, once you've run your journey, when you sell out, and hopefully you're all building practices that one day you can sell, but when you sell out, then we pay the tax. Not now. Now we want to keep as much as we can in the bank so we can build. Later, we pay the tax.
So how do you get your tax compliance every year if you do that? If you keep the tax in your account? Okay.
When I say later we pay the tax, there's a difference between the 27% we pay as a incorporated and the 45% we pay as a individual. That's an 18% difference. We want to save the 18% difference. So you're still paying your 27% now to keep you compliant. But that 18% saving for later on when the money is eventually paid to you as the individual, that we want to save and that we want to keep reinvesting so that we can grow our practice and build our careers. Makes sense? And other considerations for an incorporated is building a more sellable practice. You must, when you register an incorporated, like we previously said, there are going to be some administrative costs. And you have to get a new practice number, and there's some admin around that. Another thing, has anyone heard of a small business corporation? Great. I'm glad in this audience there's one person. A small business corporation is a new tax regime that SARS has put in place for businesses earning less than 20 million rand turnover every year. And it's favorable tax rates. So what you need to be doing is saying, when I incorporate, how can I meet the recognition requirements to be classified as a small business corporation? Because just off that, I think just off that per year, there's probably a 250,000 rand tax saving just by being a small business corporation. And there's ways to do it. Like, it's something that you have to think about and have to plan or gear yourself to work towards it. But I would familiarize myself with that term and ask your accountant whether you are or not, and how you get there, because it's a real good tax saving. Then lastly, now our ink's grown. We've got multiple practices. We're generating 1 million rand turnover a month. We've got a really, really good business. Why do we recognize, or why do we want to establish a trust? Two reasons. One is wealth protection. The other is estate planning. So when I talk about wealth protection, a trust is not a company. Think of a trust as a living person. It's like something you give birth to. A trust lives on past you. A trust has a life of its own. A trust has trustees and a beneficiary. It carries on. But because a trust is its own living person, there's no shareholders in a trust. No one owns a trust. A trust is there. It's in legal terms, it's got the same rights as a human being. Now, as we previously said, you're accountable in your personal capacity for any claims made against you. Now you go and you build your practice, you go invest into properties, you go, build more investments. You accumulate wealth in your personal capacity, but that wealth is technically at risk. Because if anything happens, your creditors can come claim the wealth that you've built because of a mistake or something that happened within a practice environment. And that's why we issue or build a trust structure, because they can't go after your trust. Your trust is completely separate to you. And whatever you have, if you build your wealth in your trust, no one can touch it. So it's protected. The second one is estate duty, so tax planning. Like we said just now, we know at some point we're going to die. When we die, has anyone heard of estate duty? Show of hands? Yeah? Estate duty? Yeah? Okay, so estate, and SARS they eat all sides of the carcass. When we die, 20 to 25% of the value of our entire estate goes to SARS as estate duty. And this is the biggest trick in the world, right? So we build our value within our personal names as our sole proprietor or incorporated. So we build it on the unprotected side of the structure. And let's say our estate's worth 20 million. And that's not unreasonable. 20 million by the time you're 80, 90, that's, especially in your profession, that's massively doable. Now you die, 20% of that's 4 million. 4 million needs to go to paying tax on the day they wind up your estate. But who's sitting with 4 million rand cash in their bank? I don't know. If you are, well done. But not many people. So where's your money? It's tied up in investments. It's tied up in properties. It's tied up in a house. It's tied up all over the show. But before the executor of your estate can distribute your assets to the beneficiaries, they need you to pay 4 million rand. So what do you have to do? Well, you've got two choices. Either your family need to sell assets. They need to cash in offshore investments or sell a property so they can get liquid cash to pay SARS. Or we go to our best friends who are our financial advisors and they sell us life insurance policies. And then they say to us, okay, cool, come buy this life insurance policy because, your estate's going to be worth 20 million and the tax is going to be worth 4 million. So let me sell you a 4 million rand life insurance policy. And what do? Now you're paying life insurance so that one day when you die and the insurers pay you the 4 million rand, you can pay it to SARS to cover your estate duty. It's nonsensical. Like, we know that's going to happen. Just once your estate reaches 5 million rand in net asset value, register the trust, and then guess what happens to your estate duty? Zero. Not a cent. Not a cent of estate duty gets paid to SARS. We know it's going to happen. Plan for it. If you leave it too late, and eventually you want to then start transferring assets. So we're in our 50s and we want to start getting some of our assets into the trust. Not only is there estate duty when we die, but there's donations tax. So SARS is going to tax us on donations 20 to 25%. We have to pay 25% on whatever we donate out of our personal name into our trust structure. It's the same thing. So we might as well just keep the value in our name. And when we die, pay the estate duty, because then it becomes our children's problems and it's not our problem. But it's not really a tax efficient structure. It's really important. And the trick, and this is where we spent a lot of time and energy getting legal opinions, researching HPCSA requirements as to how to make this possible without infringing on any regulation. So our management company is where we start invoicing our incorporated on a monthly basis for services rendered to our incorporated. So we can get money from the unprotected structure into the structure without creating any type of loan accounts, any type of debt, like this is a pure commercial transaction. There's a lot that the HPCSA require in terms of how this practice management company is set up and the fees and the amount that is charged on a monthly basis. It has to be set up correctly, otherwise you fall foul of their guidelines. But that's a really clever way to start early on getting money from your practice into a protected structure to protect your wealth, in some instances optimize your tax, and in all instances save you 20% on estate duty. And then the last one over here is, and I don't want to get too technical, but there's a 20% dividend tax on any. Do you know what a dividend is? Sorry. Okay, we kind of know dividend. Okay, so a dividend is when a company makes a profit. When I distribute those profits to the shareholder of that company, that's called a dividend. Now, distributions from a company to an individual carry dividend tax of 20%. This 20% number is coming up a lot. So SARS obviously likes 20% of, so basically they're your fifth child if you look at it. And there's a 20% dividend tax that's paid from a company to an individual. But the catch is, when we pay dividends from a company, which is your management company, to your holding company, which is ideally your investment company. This is the company that we do all of our investments in. We buy property through that. We invest offshore through that. We put money into Coronation or Allen Gray or Old Mutual, wherever you want through that. That's our investment company. When we declare a dividend, it's 0%. There's no dividend tax between South African residents companies. So not only is it a really good wealth protection and estate planning structure, but from a tax perspective, we're delaying our tax payment to later. And money in the bank now means we can invest more now, means we can grow more now, means that later on, eventually when we decide to sell out, we've got a bigger piece of the pie. And we're going to pay more tax then, but we're also going to keep more for ourselves at that point in time. Yeah, and I think that's about everything. I'm gonna open the floor to questions, but before I do that, this is a QR code. If you want, you can scan the QR code, and it's going to take you through to WhatsApp. And it's going to ask you a couple of questions on WhatsApp, which I encourage you to please answer. And what we do is we just keep sharing information. Like, we're all about information sharing and mutual success. So if we can help you be more financially astute and run better and bigger practices, then that's great for us, because we end up building our brand and hopefully we get some referrals. But we don't spam you. We share content on a once a month basis. And every time something really important comes about, we'll let you know about it, so that you're in the forefront of knowledge. Yes.
Thank you. Questions?
Thank you, George. As medical people, we do medical. We don't understand this kind of stuff. So we hire someone to do this stuff. What are some of the things we need to be asking of our accountants and tax practitioners to know that they are doing what we don't understand that we've paid them to do? So tax compliance, VAT statements from SARS, e-filing, because remember, the accountants hold the profiles. We don't see them. What do we look for to do checks and balances?
Yeah, it's a great question, and I probably should have a better answer for that. So, did everyone hear the question? Yeah. So firstly, what you mentioned, tax compliance, filing returns, all of that has to be done. I mean, like, a very important thing to understand, as a taxpayer, you are the taxpayers, not me. You're the taxpayer. The taxpayer is liable to SARS for all the debts, right? So if I'm a accountant or registered tax practitioner and I'm doing your monthly filings and I'm not doing it correctly, you're liable for my work, not me. You are. And we often work with some clients that come back and say, oh, but with my last accountant, I never paid any tax, and now with you, I'm paying tax. I'm like, yeah, because as much as it's my job to optimize your tax and reduce it as much as possible, it's my job to protect your interests. Because in 10 years' time, when SARS comes back and says, you owe me all the outstanding taxes plus interest for 10 years, plus 200% penalties for tax evasion, you're liable. I'm gone. I'm in Mauritius. It's you. So working with the right advisor and tax practitioner is really, really important. to figure out if they're right, I don't know. It's a tough one because you get really, really good accountants. People with just a BCom degree, but they've got excellent experience and they know their job and they do it well. And then you get CAs that just don't understand what they're doing and they muck it up anyway. So I think to make sure that they're doing planning right is to actually sit and ask critical questions around what are you doing to save me tax? What incentives or allowances does SARS have available that that you can utilize to my advantage? Tax compliance is a non-negotiable. You should be getting a tax compliance status every month. And your accountant, although they have your profile, you also should have access to your profile. And if you're not getting monthly management accounts, move. Or tell your accountant to give them to you, but if they're not giving them to you, move. Because immediately that's a sign that they don't have an understanding of what's happening in your business. And how can you be tax compliant if they don't know what your numbers are? Because what are they filing? Then they're filing garbage. But yeah, I don't know what the exact, I don't know if there's a checklist, but it's a relationship. It's making sure that, they're reputable, they understand what they're doing, and you've built a good relationship with them.
Thank you. We have a question here, but I just want to add to that. So I think also as health professionals, I'm an OT, but if you bring a hand patient to me and ask me to make a split, I won't know where to start, even though I trained in that, right? So the similar thing with accountants, that they may be trained in accounting, but if they haven't got experience or put in the effort and the time to go and learn about the HPCSA regulations, then they're not the right accountant for you. So I think one of the questions would be to ask them, do you know what the HPCSA regulations are? And you, as being the liable person, need to actually understand that yourself. And the other thing is that what most practitioners I find do is that they'll employ a keeper or an accountant and then just send them everything and never have a conversation with them again. This should be a relationship. It's kind of like your other psychologist, but just for your business, right? So if a person that works for you contracted doesn't have that open relationship with you where you can ask them questions and ask them to set up your profile and do all of those things, then they're not the right person for you.
Yeah, thanks a lot for a wonderful presentation. Of a lot of things that we are not very clued up about, but we thank you for the enlightenment. My question comes on the issue around the trust. I have been informed that the trust taxes is at 45% of the income of the trust. And the other thing is, if we want to put some of the properties or the assets in the trust, what is the best possible way to do it? Can you do it as a donation, or can you sell properties to the trust? And if you do sell, how do you go about the capital gains taxes? And if you do a donation, maybe just enlighten us how is a possible way, or what is a possible right way to do it?
Do you have time?
Yeah, we're a little over time, but just answer that question. And then if anybody else has questions, George does actually have a stand just down this passageway here. So you're, of course, welcome to go and chat to him, especially because some of the questions might have more specific things he needs to know. But if you can just answer this question. Thanks, George.
Okay, I think it's a great question. So, and you're 100% right. Trusts are taxed at 45%, right? But at no point must any income be retained in the trust. So when you're setting up the trust structure, it's really important to have a holding company underneath. So you've got your trust, your holding company, and whatever investment entities you have under that. But this is where your money sits. Your money sits in the holding company, not the trust, purely for that reason, because trusts are taxed at 45% unless you distribute all those earnings through to the beneficiaries, which you don't necessarily have to do. So that's the one. When you're buying property, investments, whatever assets you buy, it's not bought in the trust. It's the holding company that's buying the asset. And there's a number of reasons to do that, because when those assets start generating income, that income's taxed at 45%. We don't want it taxed at 45%. We want it taxed at 27%, which is the holding company tax rate. Okay. Then if I'm sitting with personal assets and I now need to get my personal assets to my trust, I don't do it to the trust. Because there's an anti-avoidance rule and it gets technical, but there's an anti-avoidance rule called Section 7C. And Section 7C says any founder, any person who founds a trust or is a trustee of a trust that makes a donation to the trust will be charged 7C interest on an ongoing basis. And that's just to avoid kind of like tax avoidance rules. But there's no Section 7C provisions for loans made from me in my personal capacity to my holding company. So that's, again, a reason why I want to do it through my holding company, because I avoid the 7C. At some point in life, the tax is going to catch up to you. It's inevitable. It will. But we want that to be later on, not now. Yeah, did that answer your questions? Yeah. Guys, thank you very much for being such an engaging audience. I do have a stand just literally behind AstraZeneca. So if you want to have a chat, please come speak to me. I love imparting knowledge and happy to share. Thank you.